International Financial Management. It is nothing but international capital budgeting. Decision-making techniques in capital budgeting. First one, NPV method. NPV equals to present value of cash inflows minus present value of cash outflows. Present value of cash outflows means initial investment. If NPV is positive, accept the project. If NPV is negative, reject the project. Next, IRR method. IRR means minimum required rate of return method. It is the rate of return from the project. It is the rate at which present value of cash inflows equals to present value of cash outflows. At IRR, NPV equals to 0. IRR is calculated using trial and error method. Interpolation method is used for calculating IRR. If IRR is greater than cost of capital, accept the project. If IRR is less than cost of capital, reject the project. If IRR equals to cost of project, it is an indifference point. Next, modified NPV method. In this, all cash flows received during the life of the project will be reinvested till the end of the life of the project at other discounting rate. So, present value of cash inflows equals to cash flows at the end of the project divided by 1 plus KO whole to the power T, where KO is the discounting rate, T is the year of end of the project. That means a final year. So, modified NPV equals to present value of cash inflows minus present value of cash outflows. Next, modified IRR. In case of modified IRR, no trial and error method is required. In this, modified NPV equals to 0. IRR means rate at which present value of cash inflows equals to present value of cash outflows. How to calculate modified IRR? R equals to square root of T terminal value divided by initial investment minus 1. Next, cash flows from project point of view, that is equity preference debt. Project or firm's point of view. Cash flows are of two types, outflows, inflows. Outflow means initial investment in the project by equity preference debt and initial investment in working capital. Next, cash inflows. Cash inflows can be during the life of the project, that is future free cash flows to the firm, or at the end of the life of the project. During the life of the project, free cash flows to the firm. How to calculate free cash flows to the firm? Income minus expenses gives EBITD, minus depreciation gives EBIT, less tax gives no PAT, plus depreciation gives, plus depreciation plus or minus changes in working capital gives free cash flows to the firm, or cash flow after tax. Next, how to calculate inflows at the end of life of the project? Salvage value will be considered net of tax. We need to release working capital also. Important point is, in mergers and acquisitions and corporate valuation, while calculating inflows at the end of life of the project, there will be no release of working capital. But here, there will be release of working capital at the end of the project. Next, do not consider sunk cost or historical cost because that cost is already incurred. Next, do not consider allocated overheads or allocated cost. Opportunity cost is considered while calculating above cash flows. Discount rate from project or firm point of view, that is equity preference data, it will be weighted average cost of capital, KO. KO, weighted average cost of capital equals to weight of E plus KE plus weight of P plus KP plus weight of D plus KD. KE equals to RF plus beta into R minus RF. KP equals to preferential dividend rate. KD equals to capital into 1 minus T. Discounting rate should be risk adjusted according to the project. How to calculate risk adjusted discounting rate? RIDR equals to 1 plus RF into 1 plus RP whole minus 1. How to calculate levered beta? Beta levered equals to beta unlevered into 1 plus debt by equity into 1 minus T. Inflation in capital budgeting. Cash flows are of two types, nominal cash flows or money cash flows and real cash flows. Real cash flows means inflation-free cash flows. Nominal cash flows means value which includes inflation, that is out-of-pocket cost. What is the relationship between real cash flows and nominal cash flows? Real cash flows for T years equals to nominal cash flows for t years divided by 1 plus inflation rate whole to the power t. A relation between nominal rate and real rate. As per International Fisher effect, 1 plus nominal rate equals to 1 plus a real rate into 1 plus inflation rate. Final conclusion is, if cash flows are real, use real discounting rate for calculating present value. If cash flows are nominal, use nominal discounting rate for calculating the present value. If the question is silent, assume cash flows are nominal, use nominal discounting rate for calculating present value. Forex and capital budgeting. All cash flows and discounting rate should be of same currency. If cash flows are of different currency, convert cash flows into other currency using exchange rate between currencies. Exchange rates of different years may be estimated using interest rate parity theory and purchasing power parity theory. As per interest rate parity theory, F by S equals to 1 plus RD divided by 1 plus RF. RD means rate of interest of domestic country, RF means rate of interest of foreign country. As per purchasing power parity theory, F by S equals to 1 plus RD divided by 1 plus RF. R means inflation rate of a domestic country and RF means RD means inflation rate of domestic country, RF means inflation rate of foreign country. Base currency is the currency for which forward rate is to be calculated. If required rate of return is given in the question, assume it is of home currency of investor. How to calculate adjusted present value? First, calculate NPV using free cash flows to equity and discount rate for equity only, plus present value of interest tax shield using pre-tax interest rate. We will get adjusted present value. Inflation is inversely proportional to currency strength. If in the question home currency approach is given, we convert home currency to foreign currency. Next, if in the question they were asked to calculate through foreign currency approach, we discount foreign currency using RADR, risk adjusted discounting rate. Purchasing power parity theory, F by S equals to 1 plus RD divided by 1 plus RF. RD means inflation rate of domestic country, RF means inflation rate of foreign country. Same IRP, interest rate parity theory, F by S equals to 1 plus RD divided by 1 plus RF. RD means interest rate of domestic country and RF means interest rate of foreign country. NPV equals to present value of cash inflows minus present value of cash outflows. If NPV is positive, accept the project. If NPV is negative, reject the project. If rate is same, we need to convert to same currency into different currency, divide. At IRR, NPV equals to 0. That is present value of cash inflows equals to present value of cash outflows. This year calculated tax is paid in next year because of assessment criteria. Next, how to calculate adjusted NPV. Adjusted NPV equals to basic NPV plus present value of tax shield on interest plus present value of interest subsidies.